Hello, in this lecture we will continue on chapter 23 talking about the cost variance analysis, and we are going to move on now to an actual computation of the cost variance analysis. So management needs information about the factors causing cost variance, but first it must properly compute the variance. In its most simple form, a cost variance is computed as follows. So we're going to take a look at some formulas. They can be a little confusing to look up at first, but once we get used to the terms, they're not too bad. So what we're going to use is cost variance, and we're going to abbreviate that with CV. Actual cost, this is what actually happened, with AC, and the standard cost with SC. So the cost variance equals the actual cost, what actually happens, minus the standard cost. That's the variance. So the cost variance is the difference, basically. The cost difference being the actual cost, what actually happened after we ran the process, minus compared to what the standard cost is, which is basically the budgeted cost that we thought would happen, where the actual cost equals the actual quantity times the actual price. So how do we come up with the actual cost? Remember, there's two components. There's the actual quantity, how many units we used. So if we're producing things, then we're seeing how many material units we used times the price per unit of material we used. And then we have the standard cost being calculated as the standard quantity, the amount we budgeted to use per unit that we're going to make, times the standard price of materials, in this case, if we're talking about materials that it took to use them. So there's going to be two components within each one. So the actual quantity is going to be abbreviated AQ, is the input material or labor used to manufacture the quantity of output. The standard quantity, SQ, is the standard input for the quantity of output. And then if we take a look at the actual price, AP, is the actual amount paid to acquire the input versus the standard price, which is SP is the standard price, the budgeted price. So let's do a calculation on this. So we're going to take a look at the calculation in this format. We're going to break up the total variance between its two components, once again, the price and the quantity. So let's say that there was a difference or a variation in the amount we paid for materials. The question then is, what is that due to? Is it because the price was different? Did we pay more for the materials than we should have? Or is it because we used more of them in the production? So if we take a look at that, then the price variance is the difference between the actual price and the standard price. And the quantity variance is the difference between the actual quantity and the standard quantity. To assess the impacts of these two factors in cost variance, let's look at a model. So here we have a model of this. One way to pictorially look at this would be to take the actual price. Remember, what we have in total is a total variance. So if we're talking about the variance in materials, we have a total variance that we are now breaking out to the price variance and the quantity variance. How can we calculate the price variance and the quantity variance? Well, we can say the actual quantity is the constant here, and we're comparing actual quantity and actual quantity. We're taking actual quantity times the actual price and taking that compared to the actual quantity times the standard price. So the difference between these two calculations when we compare the totals is due to the actual price versus the standard price. And that, if we subtract these two out, then we will then get the price variance, as opposed to the difference over here being the actual quantity time and the standard quantity. So if we take the actual quantity times the standard price and compare that to the standard quantity times the standard price, now the standard price is constant and the difference is the actual quantity and the standard quantity. The difference is the quantity amounts, and then if we subtract those amounts out, that gives us the quantity variance. If we added those two up, then that gives us our total difference in, say, material in this case. So if we did a cost variance computation this way, we can also do that same representation rather than breaking it out in the long way and doing this calculation, this times this, and this times this, and then subtracting. We could have a more simplistic formula like this. We can say, to give us the actual price minus the standard price times the actual quantity. And notice what that is doing. It's taking what is different up here, the actual price less the standard price per unit, and multiplying it times what is the same, which is the actual quantity. And we could do the same thing over here. We could take the actual quantity minus the standard quantity and times that by the standard price. So we're taking the actual quantity and the standard quantity, the things that are different, and multiplying it times the one that is the same. And this will be a quicker formulaic way to do this type of calculation. So computing materials and labor variances. So here we go. The company makes golf clubs heads with the following standard cost information. Direct materials 0.5 pounds per unit at $20 per pound gives us a cost of $10. And the direct labor is going to be 1 hour per unit at 8 per hour gives us $8. So when we think, and then so the total cost is the 18 being the materials and labor. So when we think about the variances, then we're going to break this out and say, well, what actually happened in terms of both materials used and labor? What are the labor and material variances? And then when we break out the labor and material variance, we can break that down further and say, what is the difference in the material variance? Is it the amount of pounds we used, or is it the cost per pound? What is the difference going to be made up of? So if we then say that during May, they produced 3,500 club heads using 8,000 pounds of materials, and they paid $20 per pound for the material, we can then conduct our variance analysis in this way. So if we take a look at it in this format, we're going to say the actual cost times the actual price. We're saying that we actually had 1,800 pounds times the actual price, which was 21. If we multiply that out, we get 37.8. If we compare that to the actual quantity times the standard price, remember the thing that has changed now is the price, then we come out with the 36,000. And then if we compare those out, that will give us the price variance, which is unfavorable in this case. And then if we do the same comparison on this side, then we're taking the actual quantity times the standard price, and then we're comparing that to the standard quantity, that's the thing that has changed, the standard quantity, times the standard price, the thing that has now remained the same on this side. That gives us the 35,000. And once again, if we compare that, we get a quantity variance of 1,000, which is also unfavorable. So we're left with a 2,800 unfavorable business variance, and we're going to apply that to 1,008 of it being due to the price variance, the difference in the price. We paid more per unit than we thought, and we think that's costing us 1,800. But we also have an unfavorable quantity variance, meaning that we used more material per unit than we thought we were going to. So now we got to analyze this out, and if we take a look at this and we ask, well, what's going on here, we could get some different opinions depending on the department we ask. So who's responsible for the material cost variance? And this individual is going to say that I'm not responsible for this unfavorable material variance. You purchased cheap materials, so my people had to use more. So he's obviously in charge of the production, and we're coming to him and saying, hey, there's a material variance. You used more materials than we budgeted to do. Why did that happen? And his explanation, of course, is going to be that we didn't buy quality materials, therefore it cost more materials, and that may or may not be the case. And then, of course, if we talk to a different department in the purchasing of the materials, they may say that you use too much material because of poorly trained workers and poorly maintained equipment. Also, your poor schedule requires me to rush order materials at a higher price, causing unfavorable price variances. So the purchasing department may have a different outlook on this and say that it's due to mismanagement of the individuals that are using too much materials and causing a higher price in the cost of the materials. So even when we come up with a variance, it's not clear cut as to what the problem is, but now that we have broken it down to its components, we can do a better analysis and try to drill down further on where the issue is.